Hi, I'm Charlie Bowers, and we're here to talk in this section about everyone's favorite topic, taxes. And I'm especially enthusiastic about it right now because it is tax season as I'm filming this, and I've just been to see my tax preparer. And we just had the 2017 Jobs Act and tax law, and it's just a lot of commotion, a lot of talking about it, but we're going to talk about a little bit here in this session about taxes and how important that is in retirement for you. You know, a lot of people don't talk about taxes as much as they possibly could when it comes to retirement. What have we been taught in this country? That when we're in retirement, we're going to do what? We're going to end up paying less taxes, aren't we? And why is that? Well, we're going to be in a lower tax bracket. Okay, maybe. Why is that? Because what's the rule of thumb people talk about in income need in retirement? Oh, I'm going to need 80%. I'm going to spend less. I need 80% of my current income. Who out there wants to live off of 80% of what you're spending now? Show of hands? No one really. And if you think about it and run some numbers, you may be in a position where you're even taking more income in retirement than you do right now. So saving taxes is huge because every dollar of tax you save, that's a dollar in your pocket. So understanding how to save taxes is important, and you need to start planning for that. There's a certain age bracket where you might be able to take into account to utilize some tax strategies that's going to even make your situation better than it really is. So we're going to talk about a little bit about some tax strategies, but the first thing to do is talk about the Tax Cuts and Jobs Act that was just passed in December of 2017. So what's going to happen because of this? Well, we've got the tax bracket rates have been lowered and they've doubled the standard deduction, but they've gotten rid of personal exemptions. So what does that mean for you in your tax situation? Who knows? It may depend on how many kids you have to gather those personal exemptions. So you really need to start opening that conversation with your tax professional right now to understand what the situation is and what you should be doing immediately to better prepare yourself for 2018. Maybe to make up for some of that personal deduction elimination, they double the child tax credit from $1,000 to $2,000. One good thing is that we all know that 529 plans have typically been used for higher education purposes only. But now for up to $10,000 a year, folks can use 529 plans for primary and secondary education. So a family that sends their kids to private school may really benefit from this growth in use of the 529 plans. But along with that, doubling the standard deduction, they've gotten rid of some deductions that we've used in the past, and I've kind of given it an acronym called MATH so I could remember what they are, like moving expenses, no longer able to deduct them, alimony, tax preparation services, and then the interest on your home equity loan is no longer going to be a possible deduction for you. And with all of these new rules, right now they have a time limit where they phase out, like in 2025. So, you know, this is the way it is now. I don't know, the IRS has read through it all and come to their own interpretation. So there's probably still some more juggling that has to be done with the tax situation. And again, I suggest talk to your tax professionals now about 2018, what you should be doing moving forward to best prepare yourself. One other thing that you need to take a look at, you know, one of the options that people say, I'm going to prepare my future self for tax benefit to minimize taxes as best I can, is I'm going to convert some of my traditional IRA to a Roth IRA. And that's a great thing. There's a couple of reasons where that might not have worked out for you in the past, where all of a sudden the market drops and you've paid taxes on what was here, but it's now worth here, or you just can't afford to pay the taxes at all. Well, Uncle Sam's decided no more recharacterization of conversions. So if you're going to convert an IRA to a Roth IRA, you can't undo it, so make sure you really want to do it. So let's look at, I don't know if you call it an ugly chart or a good chart. You know, taxes now, the top tax rate is 37%. So relative to where we've been all these years in the United States, that's not a bad tax rate. Taxes are essentially on sale right now. So in talking to your tax professional, does it make sense to go ahead and pay some taxes up front today so that who knows where Uncle Sam's going to have the taxes in the future. Usually in these classes I ask, where do you think taxes are going? Up until this recent tax reduction, people said, oh, taxes are going up. There's no way they could do anything else but go up. And, they've gone down. But that's not to say that the next administration might not decide, hey, we need to raise tax rates again. And if you look at this chart, back in 1944, the top tax rate was 94%, meaning for every dollar you earned, if you were paying that tax rate, you got to keep 6 cents. And we all remember Ronald Reagan. Well, he was making movies at that time. He said, I will only make 2 movies a year just because of that ridiculous tax rate that I'm going to be charged. It's not worth my time to make the movies. And then he becomes president now, and he has the biggest tax decrease there was up until Trump says this current one. But he reduced taxes greatly. And why? Because he lived that high tax life at that time, and he understood, that's kind of a burdensome responsibility to place on people. And then we go back to what people say, oh, you're gonna take less money in retirement, less income, won't need as much. And this is one of the reasons they say, well, let's defer tax now and we'll pay it later because you'll be taking less tax and you'll be in a lower tax rate. That may or may not be true. The thing that we all think about is this highest tax bracket rate. The thing we don't always think about is the lowest. Our lowest tax bracket rate was 0 at one time. If Uncle Sam decides he needs to raise taxes, well, it's not just the top one. It could be the lower one, which could impact everybody, not just the top tax rate. So consider your plan going forward. Do I want to pay taxes now so that I can have a tax-free bucket in the future, or am I happy deferring taxes now and I'll just deal with it when the time comes? So a few ideas that we talk about in our class on how to possibly reduce your taxes. The first one is timing is everything. You've got someone that works at a company, been there a long time, it's time to retire, or they're offering him a package. In that 1 year, he might get salary for a portion, a bonus, whatever his severance or relocation or thank you for working for us package. And what you're doing is you're lumping a bunch of money in 1 year, and it might elevate you into different tax brackets. So if you can spread that out over a 2-year period, may be an example of how you can reduce your tax burden. Number 2, starting a business. Growing up, high school, you probably had passions. You worked on cars, or my father-in-law always wanted to be a fishing guide on one of the lakes around where he lived and thought that was a wonderful thing. And businesses can be a great way to deduct expenses. And you're doing something you love and may make a profit, but at least you have some expenses that you can deduct. Tax credits, we talked about charitable donations. Reinvest dividends means not everything has to come out of an IRA or 401k where everything is viewed as ordinary income. Some investments have better tax benefits in terms of how much percentage Uncle Sam's going to take from your earnings, like long-term capital gains tax for qualified dividends and how long you hold certain investments. Contribute to your IRA. I said this is still tax season. You can still contribute to your traditional and defer those taxes. The question is, does it make sense? Maybe it does, maybe it doesn't. That's where you need to have a conversation for your specific situation. Convert your IRA to a Roth IRA. That's kind of looking to the future. Does it make sense? Is that where you want to be, to have a tax-free bucket of money where you might be able to blend your income streams, your deferred tax streams, your fully taxable streams, and your tax-free streams. Try to blend them in such a way that you might be able to minimize your taxes and minimize taxes on your Social Security. So all of that needs to be considered and strategized for as you plan for a successful retirement. And another way to get that tax-free bucket, we talk about a Roth IRA, which most are familiar with. There are certain life insurance designs that are set to pay a tax-free income. And to let you know that some people think it's really good, some people do call them a super Roth. So that may be an option for you in your situation. It's worth a conversation. So I alluded to there's a window where you might be able to do some more high-powered tax strategies uh, between the ages of 59 and a half and 70 and a half. What is that? Well, to take money out of an IRA prior to 59 and a half, you could incur a 10% early withdrawal penalty. At 70 and a half, Uncle Sam says you have to take your required minimum distributions. So once you're past 70, you're pretty much set. If it's in an IRA or 401k, you're going to have to pay taxes on those amounts. Below 59 and a half, you may not have the ability to pull out of an IRA and do certain things, but the earlier you can start planning for your tax situation in the future, the better. So there is a window where some advanced strategies can be attempted to reduce taxes even further, because like I said, it would be so nice to have a tax-free bucket of money to play with in the future. So what's the takeaway from all of this? We are living longer. We've got to plan for our retirement to age 90, 95. We just don't know. We don't want to plan short and run out of money. So we need to plan for a full and enjoyable life. There's more of us enjoying our retirement, meaning we baby boomers are starting to flood the retirement market. So there's going to be more of us. And what does that mean? That may mean there's more stress and strain on Social Security and Medicare. So if there is more strain on that, what does that mean? Well, in light of the fact that Uncle Sam has had the highest tax bracket up in the 90% range and is down at 37, if someone in power in whatever administration is running now, is ruling then, says, I think we need to raise tax rates, well, what is that going to do? Your $1 million 401k, if Uncle Sam says, all right, we're going to have the tax rates at double what it is now. Well, instead of 12% as the lowest, is now 24%. And so your $1 million in your 401k, 24% of it right off the start belongs to Uncle Sam once you start pulling that kind of income out. And remember, at 70 and a half, Uncle Sam says, let's start taking some money out because I want my fair share. So wouldn't it be nice to have that tax-free bucket of money? And the important question is, does your retirement plan have you prepared for that type of situation? And so we always revolve back to a plan. We think that is the most important thing. And in our simplicity plan, we do bring up the conversation of taxes. And let me see if I can pull an example up here quickly. All right, so as you've seen some of these sessions, we've talked about simplicity before, and you recall that we're talking about, in this case, Sam and Sally Johnson, all of their information. This is how we organize their assets. But right here, the principal tax concern. That means Uncle Sam not only has the ability to tax your earnings, he also has the ability to tax 100% of your principal and all as ordinary income. And you see, in this case, we've got a block that goes from 0 to 100. 0 meaning Uncle Sam can't touch any of your principal, to 100% where Uncle Sam can tax all of your principal. And you see, in this case, 93% of these folks' assets are in qualified plans where Uncle Sam can tax 100% of those assets. That is not an uncommon situation, because we have been taught, fully fund your 401ks, fully fund your IRAs. These are your retirement accounts. This is the best way to save for retirement. But when you come into a situation like this, you got to say, is it really? What if my account is worth $2 million? At 70 and a half, I got to pull out $75,000 of that, whether I need it or not. So it may be a good idea, especially when you're in this situation, to start thinking about what type of tax planning can I or should I be doing. And if you look here, as we organize the assets, 401k, 401k IRA, 401k is an IRA. So that's why you're running into, this couple is running into this situation where so much of their nest egg is 100% taxable. So if you see yourself in a situation like this where tax planning may make sense for you, please contact us and we'll start working with you to create your own personal simplicity report.